Analyzing Trade Desk's earnings. Is it time to invest? Hey everyone, I'm Brandon. And the ad technology powerhouse, Trade Desk, are they too hot to handle or are they a hidden gem? I dive in, and they recently had their earnings, and kind of an interesting company. I've been investing in them and trading them for years. And the question is this, a company that we want to continue trading and investing in, or, is it a dud? I mean, they are in the really rapidly evolving world of digital advertising, and they stand out all the time. They were a company that was really hot for many years. Not too long ago, they were the stock price was at about $140 back in, say, December, and it dipped all the way down to almost $40 a share in like April. Has recently kind of recovered after the beating expectations with earnings, but right up here is about that $80 level. Is just run into some liquidity. And before I get into earnings too much, I want to take a look at the stock technically. I mean, basically some quick observations is the stock price is below the 200-day moving average. So this is not a positive sign. And also, if you look at this red 100-day moving average, it's above the more recent 50-day moving average. So not only does it not have kind of long-term momentum, but the confirmation is that it's just not a good stock recently. And so all these are, not positive signs. And then throw in fundamentals. Schwab has an equity rating of F on the stock, and which is kind of shocking to me. When I'll get into some of the numbers, but I mean the stock has no debt. I think it has over 1.6 or 1.7 billion dollars in cash. A lot of growth in international. So there's a lot of really things that are really positive about it. But I'm surprised Schwab does not like them for whatever reason. As of 6/13, they have an F rating. But other than that, it's fairly positive. I mean, CFRA has 4 stars out of a possible 5. Market Edge has them as long, the best rating they have. Argus, no rating. Morningstar's gave them a 3-star out of possible 5, so it's kind of in the middle. And LSEG has them as outperform. So a mixed bag. Schwab has an F, which is the worst rating they can have. But other than that, their ratings are pretty good. So what do? They do programmatic advertising. So they basically they're in the pulse of the ad technology industry. So if you're looking for a high growth opportunity, this could be one to look at. It's the challenge with it is that it's very competitive. Basically, the other companies that are in this similar super competitive space is Google and Amazon. So the Trade Desk is trying to carve out a market share from, Google, Amazon. And so their recent earnings reports does kind of give a snapshot of their health and trajectory. I don't want to get into it too deep, but they did beat on their earnings per share. They had a 33-cent earnings per share where the estimate was 26. The revenue also beat. They have a 25% year-over-year increase in revenue, and so that's no small feat. Their key growth drivers are their connected TV and CTV platforms. They also have a Kokai platform, which is seeing a lot of adoption. And it's not just North America. They've had 9 consecutive quarters of international revenue growth that has outpaced their North American growth. So it's a signal of their global expansion and diversification globally. And also, the thing that's always kind of interests me is they have a strong financial position. They have, for a growthy company in this type of a space, they have a decent financial health. They boast a rock solid balance sheet. They have $1.7 billion in cash and impressively 0 debt. So they're returning, some of that to shareholders as well In fact, they had a $386 million Class A common stock buyback in Q1 alone. So cash on the balance sheet, buying back stocks. These are some financial strengths that should help them against headwinds. So why is the stock in the dumps so much lately? Well, they have some headwinds, I guess. But we'll talk about those. But right now, what's kind of going in their favor there's an ongoing shift towards programmatic advertising. So brands want more efficiency, better targeting, more measurable results. All that is what programmatic advertising delivers. Also, Trade Desk can utilize AI to help them be a leader in the space. So they have emerging retail media networks. And continuous investments in AI. So their platform and their innovation, I think, keeps them competitive. So then what's the downside? I mean, it seems like they have a strong growth, revenue growth, earnings per share growth, growth around the world. They've got AI innovation. They're in a good industry. They do some things that are give them a competitive edge. And so what's the headwinds? And that's what I'm trying to figure out. I mean, really, it's part of it maybe is that they're competing against Google and Amazon. And so obviously that's going to be a challenge. So the competition, it's fiercely competitive. I think that's and these companies have deep pockets. So that's one challenge. Also, economics uncertainty. I mean, media advertising can get hurt in economic downturns. A slowdown in consumer spending or recession could impact revenue growth. So that's a factor. I think the biggest one, and I think this is why Schwab has this equity rating of F, which stuns me a little bit, but I think it's valuation concerns. The stock trades at a very high PE ratio. And, usually high growth companies justify higher valuations, but it means that the stock's priced for perfection. And I've noticed that Schwab doesn't really like, these growthy names that are priced for perfection. They don't get great ratings in the Schwab equity ratings as I've noticed. So anything that kind of happens that they don't meet their expectations with earnings or revenue, or they stumble a little bit, their growth stumbles, I really think the stock could really get hammered some more. So on the surface it looks like a buy. In some ways they've got strong performance, growth drivers, solid outlook, nice balance sheet, growth around the entire globe, great industry. But like any investment, there's all these risks, and I think that's why the stock just has not done so hot. In looking ahead, their guidance, they expect the revenue to keep growing. I think they guided at about 17% year over year, and overall, no company operates in a vacuum. All companies face their share of obstacles, and so basically, this company, we've got some competition, economic uncertainty, valuation concerns. They also had some legal challenges with lawsuits for alleged violations of security laws. Don't really know the details of that. I'm not so certain that that's leading to negative sentiment or not, or I don't know what kind of financial penalties they might run into, but it's hard to imagine that that's a huge reason the stock's so beat up. It just might be a stock that was just so good for so long that it maybe just grew too much. I mean, if you take a look at this stock over like 10 years, I mean, or at least several years, it was like under a $20 stock, It went all the way up to 140, and now it's down in that 40 level. I mean, it just seems like it's a base here. So I'm more looking for it to start to recover. I'd like to see the stock, basically at least have this 50-day moving average flip over the 100 and have some short-term momentum going. It'd be really nice if the price went over the 20-day moving average. But, by the time all that happens, maybe, a lot of the recovery will be done with, and you might be late on it. So, is it time to invest? Is it time to invest in the trade desk? Well, I don't know. That's for you to decide. This, I'm not giving any advice here. I'm just kind of going over what I do when I'm evaluating stock, and thought I'd kind of give my 2 cents on the earnings and where this stock looks like, because I've been investing and trading it for so long. It seems like it has a high valuation, a lot of competition, a lot of possibly some legal challenges, and so it's not without risk. I kind of like how it looks, as far as strong balance sheet, no debt, $1.7 billion in cash, buying back its own shares. That's something I always like. So it's just this classic growth versus risk. Ultimately, you'd have to do your own research. There's just too many other good stocks out there right now for me to personally want to necessarily take the risk on it. It doesn't have the momentum. I'd want to see at minimum this 50-day moving average pop over the 100. And honestly, I still would want to see the stock price get over the 200-day moving average. Other than that, we might just have the risk of it getting sold off every time it rallies, just like it just kind of looks like that's what it's doing here at about the $80 mark. It's selling off after a rally. Boy, it's a mixed bag, but I think I'm gonna pass on it right now for now. So, hey, if you liked my content, if you learned anything, please, feel free to like and subscribe. But I'd more so love to hear some comments. I mean, are you buying Trade Desk? What do you think of the Trade Desk? What do you think of their earnings? What do you think of this stock? There's a lot of stocks out there. Maybe you've got something that's better that you're investing in. So, leave a comment on your thoughts, and hopefully this was helpful for you. And good luck in the market.